Thank you, Mr. Chairman. Today we continue our series of hearings on housing finance reform. More than 5 years after the collapse of the housing market and the beginning of the bailouts of Fannie Mae and Freddie Mac, reforming our housing system is urgently needed and is a top priority for this committee. As we've noted in previous hearings, we are now holding a number of hearings examining the specific aspects of our housing finance system. This morning we take an in-depth look into multifamily housing, which refers to loans secured by properties with 5 or more residential units. Although the multifamily market is much smaller than the single-family market, with around $850 billion in outstanding mortgage debt, it still serves as a vital source of housing for more than 15 million American households across the country. The multifamily market differs significantly from the single-family market. While Fannie Mae and Freddie Mac suffered enormous losses on single-family mortgages during the recent crisis, multifamily loans at both enterprises experienced delinquency rates of less than 1%. There are some important lessons we can learn from the enterprise's multifamily activities as we continue to work for reform of the single-family market. Fannie and Freddie both require private sector risk sharing and high-quality underwriting on all guaranteed multifamily loans. Fannie Mae employs strict underwriting guidelines and requires originators to retain risk through its delegated underwriting and servicing system or program. Freddie Mac underwrites all its own loans and shares risk with secondary market participants through structured transactions known as K-deals. These types of policies have helped ensure that Fannie Mae and Freddie Mac only guarantee mortgages of high credit quality in the multifamily space. Still, by insuring mortgages against default, whether under the conservatorship or under a new system that involves a government guarantee, the government is inherently putting taxpayer money at risk. The government's market share of multifamily housing spiked dramatically during the financial crisis, from around 30% of originations in 2006 to around 80% in 2009. This number has moderately decreased, but Fannie and Freddie, along with the FHA, still finance a significant portion of multifamily originations, and the GSE's market shares remain at a higher level than has historically been the case. Historically, private sources of capital, including banks, life insurance companies, the commercial mortgage-backed securities market, and real estate investment trusts have played an important role in multifamily markets. Given the exceptional performance of multifamily loans, it's worth investigating whether we can do more to encourage the private sector to finance more of these loans on its own, thus shrinking the government's footprint in the market. We all agree that the status quo in housing finance is not an option. I've seen a number of thoughtful proposals offering different views on how best to structure the future multifamily market. I'm interested to hear your views on these proposals, along with any recommendations regarding how to best reform the system in a way that ensures a liquid, well-functioning housing market. How should the future multifamily housing system be structured? Who in the market should play the various roles needed for a healthy secondary market? MBA supports well-capitalized private insurers, while other groups have advocated private issuer guarantors. How should any guarantee fee be priced to ensure that the government is not underpricing risk and crowding out private capital? I look forward to working with Chairman Johnson and the other members of the committee toward a bipartisan agreement that addresses these critical issues. Thank you, Mr. Chairman.